Cars are often one of the most expensive purchases many people will make in their lives. Buying one is considered a major financial commitment. As the average lifespan of a car is now 12 years, this vehicle will last a very long time and you'll cover a great deal of ground with it. While keeping this in mind, it's good to remember the 24-10 rule as a rule of thumb to help you make sound, level-headed decisions when buying your next car. Hello and welcome back to the Finance Guardian channel. In this video, we'll be talking about how the 20-40-10 rule works so you can figure out how to apply it to your own finances. We'll also provide some insight on when it might make sense to bend the rules to fit your circumstances. Don't forget to hit that subscribe button and the bell beside it, and let's get started. So, first things first, what is the 24-10 rule? As I said a moment ago, it is a rule of thumb that can help you determine how much you should budget for a car. It basically goes like this. You will have to put at least 20% down on your car, just as you would on a home, and you must finance the car for no more than 4 years. Finally, the monthly vehicle expenses you incur must be less than 10% of your monthly gross income, including principal payments, interest payments, insurance, and even gas. There are several ways this rule can benefit you. First of all, it ensures that you can afford a down payment for the car. It is essential to keep this in mind because new cars depreciate as soon as you drive them off the lot. You may immediately find yourself upside down on your car loan with no decent down payment. You can reduce your interest cost with a 4-year car loan since you will repay the loan relatively quickly. Keeping your monthly transportation costs under 10% of your monthly income can help ensure your car does not dominate your budget, allowing you to make room for other expenses. Remember, this is just a guideline to help you make your decision. Each person's circumstances are different, so it won't fit everyone. When buying a car, you may opt to spend more money on it because it's something you value or because you have to drive a reliable vehicle to keep your job. Other people may choose to spend less on a car to allocate their money elsewhere. How the 24-10 rule works. Applying this rule in practice does take some thought, but once you understand the process, it's not that difficult. Start by finding out the purchase price of the vehicle. This will allow you to calculate how much a 20% down payment would cost. After that, you can estimate how much you'll need to finance and how much interest you'll pay. You can use this information to calculate the monthly loan payment, interest included. Next, calculate the transportation cost for a vehicle for a month as a percentage of your income. It is a bit more complicated since it entails costs such as insurance, fuel, maintenance, and more. To estimate some of these expenses, you can use a total cost of ownership calculator. It's not necessary to include depreciation costs, but you must include the car loan payment. Finally, divide the vehicle's purchase price by your monthly income. As the 24-10 rule does not specify whether this should be your net income after taxes and deductions or your gross income before taxes and deductions, you can use your best judgment or what fits your needs best. Putting the rule into practice. Let's say you had a household income of $54,000 per year. This means that your monthly gross income is about $4,500. If you were to follow the 24-10 rule when looking to buy a new car, you would need to keep your total monthly vehicle expenses under $450. The upside here is that you're limited to a certain extent when buying a new car. You must put down something on loan, which does shorten the loan's duration, at least in comparison to a typical car loan of 5 to 6 years. This means that you're likely to have a slightly higher monthly payment on the car than someone else buying the same car. But for a more extended loan period, so you are less likely to buy a car you cannot truly afford because you are aware of the payments. Let's look at another example. Suppose Mark took out a $25,000 car loan without following the 24-10 rule. That is, he did not put the 20% down on the car. So, he has a loan of $25,000 bearing an interest rate of 4.4%. The loan term is 60 months and his payments are approximately $465 per month. Throughout the 5-year loan, he pays nearly $2,900 in interest or slightly under $50 a month on average. That's all fine and good, but what would have happened if John had followed the 24-10 rule? In this case, he would have gotten a loan for $20,000 since he made a $5,000 down payment, and the loan would have lasted 4 instead of 5 years. Assuming the interest rate is the same, he would have a monthly payment of $455 and would pay about $1,850 in interest. It gets even better from there. Since he will be out of debt a year sooner, he may be able to use that 5th year to save for his next car purchase. If you did that for the 5th year, putting $455 a month in the bank and assuming zero interest, you would have about $5,460 in his savings account sitting there waiting for his next car. That amount is more than enough to cover the down payment he made for his current car. As you can see, it makes quite a bit of difference. Using this rule is certainly better than using no rule at all. So if you're in a position where you don't really have a guide to determine how much you should spend on your next car, give this rule a try. Potential drawbacks to the 20-4-10 rule. Note that this rule is far from perfect. It doesn't work for all car buying situations. Even though the rule allows you to spend up to 10% of your monthly income on transportation costs, your monthly expenses may prevent you from spending quite that much. You may also be able to spread your payments over 5 or 6 years instead of 4 to reduce your monthly payments. But just a fair warning, you should be careful when extending your car loan beyond 4 years, especially if your credit score is low. Your monthly payment may be lower, but you are likely to pay more interest in the long run. In January 2021, the average brand new car cost about $40,857, according to vehicle valuation and information source Kelley Blue Book. This means that you would need a monthly income of $9,086.88 or an annual income of $109,042.50 to follow the 20-4-10 rule and pay $726.95 per month for a car loan, even if you have excellent credit. If your other monthly expenses are low, adjusting your budget may help you to afford the monthly payment on a new car. In this case, you can increase the 10% part of the rule, thereby enabling you to afford a more expensive car. When to use or avoid the rule. Generally, this rule can help you avoid overextending yourself when purchasing a car. Financially stable individuals can consult this rule for a reasonability check before buying a car, while on the other hand, people with limited incomes and young adults just getting started in adulthood might find this rule unreasonable. If they want a car that fits their budget and needs, they may need to make adjustments either up or down. Strategies to stay within your 20-4-10 budget. Here are a few ideas to consider if you want to stick to this rule. Increase your down payment. Consider buying a base model instead of an upgraded model. Consider what's left over from last year's new car inventory. Buy a used car instead of a new one. Keep your current car longer and set aside what would be your monthly payment until you can save more for a better vehicle. Hold on to your current car for longer and set aside what you'd be paying every month until you can save more for a better car. Depending on your situation, this rule may make sense to you, or it may be an outdated guideline that hasn't kept up with your reality. You can give yourself a quick reality check by considering the rule before making a purchase. The key is to realize that you alone know what you can afford. This rule of thumb can be used as a guideline rather than a strict rule to follow as long as your car purchase fits within your budget. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.